CEO, and Managing Director Mohit Joshi, Chief Financial Officer Rohit Anand. Without any further delay, over to you, Mohit.
Thank you, Abhilasha. So good evening to everyone. It's really a pleasure connecting with you again. In addition to the updates from the recent quarter and the financial year, Rohit and I will also share our 3-year strategy with you later today. We will touch on the actions that we've already taken to achieve our goals. But before we deep dive into our roadmap for FY27, we will brief you on Q4 and the FY24 performance. The earning highlights are as under. We reported a revenue of 1,548 million in the previous quarter, which is mostly in line with our expectations, as the one-off revenues in Q3 were not expected to recur. We will close the year with revenues of 6.277 million, which is a decline of 4.7% in constant currency basis as compared to the revenue in FY23. This revenue is mostly driven by declines in the communications vertical, while the non-communications vertical has remained stable year on year. We reported an operating margin of 7.4%. We reported an operating margin of 7.4% and free cash generation of $129 million in Q4 FY24. For the full year FY24, we have generated free cash of 676 million. We signed large deals with a TCV of 500 million in Q4, taking the total deal win TCV in FY24 to around 1.9 billion. This also includes the 2 large deals that we signed in Q4, each over 100 million in TCV. A couple of notable deals include our deal with a large telco and our longtime partner to transform their business processes across multiple service lines that include customer operations and experience, complex enterprise operations, back office and support operations through deployment of intelligent automation and new age customer experience technologies. Another deal with a European fintech major which selected TechM to enhance their customer experience and provide global support from multilingual hubs while ensuring compliance with local regulations in each of the customer markets across Europe, America, and Australia, New Zealand. In terms of awards, as you know, our strength lies in the 145,000 plus strong workforce, and a testimony to that is that we have again been recognized as the best organization for women by ET Now. We have also been recognized as the ESG Champion of India 2024 Software and IT Services sector by Dun & Bradstreet. We are the only Indian IT company in the top 5% of the global sustainable companies, and we are a member of the S&P Yearbook 2024 for the 9th consecutive year. In terms of dividend, on a full year basis in FY24, and in line with our capital allocation policy, the board has recommended a final dividend of rupees 28 per share. This will bring the total dividend for FY24 to rupees 40 per share. FY25 outlook. As we step into FY25, we believe that this year will be better than the previous one. In a world of heightened geopolitical turmoil coupled with fast evolving AI capabilities, organizations will either have to address and adapt or defend and insulate their businesses like never before. They will thus turn to technology partners like TechM, who can help them transform at speed and bring agility, resilience, and efficiency to their businesses. I will now hand it over to Rohit to take you through the financial performance in more detail. Thank you.
Thank you, Mohit. Good evening, everyone. Let me now take you through the financial numbers for the quarter and the year in a little bit more detail. As Mohit mentioned, we ended the fourth quarter at a revenue of $1,548 million against last quarter of $1,573. Now, we'd highlighted last quarter that we had some one-time revenue in Europe that won't be repeatable, and hence the reduction, if you look at constant currency basis, is 80 basis point versus our anticipated view of 1.2, 1.3%. So it's better than that. In rupee terms, our revenue was 12,871 crores versus Q3 of 13,101 crore. From a sectoral perspective, if you look at Q4, our communication business on a constant currency basis declined 1.7%, and manufacturing, the decline was marginal, less than 1%, and BFSI business grew by 3.5%. When you look at large deal, as Mohit mentioned, we increased from last quarter of 381 million run rate to a 500 million deal quarter. This was due to a couple of large deals in more than 100 million of size, and the deal wins were across verticals or segments. In terms of EBIT, we reported $114 million of EBIT profit. In rupee terms, 946 crore. This was compared to last quarter, it was 84 million and 703 crores. And hence the margin rate we got for the quarter was 7.4%, which is an expansion of 200 basis point on a quarter-over-quarter basis. We'd also mentioned last time that as part of our year-end process, we'll continue to look at all the portfolio companies for any impairment impact. So in the quarter, we've seen an impairment impact through that assessment of 37 million. At the same time, there's a consequent increase in other income or miscellaneous income, which is a reversal of earn-out that we typically keep as deferred payments for these portfolio companies, and hence that reversal in line with the impairment charges has a negligible impact on the P&L. The effective tax rate for the quarter is 30.7%, which was driven by some one-time impact we got. But when we look at the year, our tax rate is more aligned to what we had said at 25.7%. Our net profit after the tax rate is 79 million for the quarter, which in rupee terms is 661 crore, which is at a PAT margin rate of 5.1%. This is an increase of 120 basis point on a quarter-on-quarter basis. Free cash flow, as Mohit mentioned, we had 129 million of free cash flow for the quarter, and our DSO went down to 92 days, resulting out of the good cash collection that we had in the quarter. Just talking about the hedge book, as you know, we follow a hedge policy, and we have a hedge book of 2.4 billion quarter ending March against a 2.3 billion quarter ending December. Basis the mark-to-market accounting policy, we had 23 million gain because of the revaluation of these hedges, out of which 7 million is taken to the P&L, and the residual 16 million is taken to balance sheet as future reserves. Our cash and cash equivalent was very healthy at 949 million ending March, which was an increase on a year-on-year basis, where we were close to 900 million the last year. Moving to a full year performance, we ended the year at $6,277 million US, which is a constant currency decline of 4.7%. In rupee terms, it's 520 billion rupees with a decline of 2.4%. When you look at it from a sectoral perspective or vertical perspective, our communication business declined year on year by 12.4%, driven by the macro trends and some one-time revenue we saw last year. But on the other side, on key verticals, manufacturing and technology both grew year on year, respectively at 7.3% and 1%. In terms of large deal TCV wins for the year, we aggregated at 1.9 billion, which was an increase as we moved towards the fourth quarter. And some of it is driven by some conscious decision we've taken to selectively look at deals as we move forward, which aligns with our portfolio strategy. We ended the year with an EBITDA of 599 million and a EBITDA margin of 9.6%. The EBIT for the full year was 380 million, and the EBIT margin stood at 6.1%. The decline year-on-year basis is predominantly driven by the revenue pressure that we saw, some of the one-time client actions where they reduced their business as a part of alignment at their end. And then from our perspective, we took some actions on de-risking the portfolio, which resulted in a reduction in revenue. Free cash flow for the year was very healthy at 676 million. And as Mohit mentioned, the board has approved a final dividend of 28 rupees per share, which coupled with the interim dividend of 12 adds to a 40 rupee per share payout. Thank you. We'll now take it to Q&A. Abhilasha.
Thank you, Rohit.
I wanted to give this to you. Thank you, Mohit and Rohit. We will now conclude this stream for those who have joined us on social media. Thank you everyone for joining us. We will now open the conference for a Q&A session for media friends who've joined us virtually, as well as all of you here. Those who have joined us virtually can post their questions in the chat box and we'll take them one by one. Roshan, can we have the mic? If you can just state your name, publication, introduce yourselves, and then go with the question.
Yeah. Hi Mohit, hi Rohit. This is Ritu Singh from CNBC TV 18. Mohit, I know you said you'll outline the turnaround plan sort of later, but if you could just start by giving us a brief sense as to what the goalposts are. You've earlier said you're looking at improvements in revenues and sales and margins, and right now, Tech Mahindra has been consistently lagging the industry. Margins have come down to single digits compared to 20+% from some of your peers like Infosys and TCS. So I was wondering if you could give us some sort of goalposts as to where you're targeting to be. Even in terms of guidance, I know Tech Mahindra hasn't given it in the past, but perhaps coming from Infosys, if you'd like to tell us something about the outlook for the year, in terms of discretionary spending, you spoke about, a one-time client action that impacted revenues in the quarter, but, what are the sectors where you're seeing some weakness? What are the sectors where you're seeing some sort of a pickup? And also a final word on the headcount. Quarter and quarter again, as we've been seeing with some of your peers as well, the headcount has been coming down for Tech Mahindra, your outlook for hiring, and any wage hikes in the pipeline.
So look, that's a lot of questions you've rolled into one. And I must say that all of you have been very patient. You've been asking me the same question since I joined in June, and you only have to wait for another 90 minutes, right? Because we're going to be doing our unveil of our 3-year strategy just in the next 90 minutes. And so we'll be sharing, giving you some...
Just a glimpse, before we get into the details.
If you waited for so long, we don't want to kill the suspense by denying you the last 90 minutes of anticipation. But essentially, look, from our perspective, like I'd shared with you previously, right? There is no doubt that our performance has to improve, and we're very clear about that. And if I think about it over the past, 4 months that I've been the CEO, essentially we have all worked together as a leadership team to build a structure, right? To build a structure and to lay down essentially the key sort of foundation stones which will help us grow in the future. And we've spoken about our strategy in terms of our plan from a revenue perspective, which is a plan for growth, which looks at our vertical mix, at our geo mix, at our service line mix. I believe our new structure truly supports that. We've also spoken about a plan from a margin perspective, right? Where we've spoken about the operational improvements that we hope to drive, about the service line mix improvements that we hope to drive, the automation and the AI adoption that we hope to drive, which will help drive our margins. We've also, in our plan, spelled out where we expect our margins to be by FY27 and how we then expect these margins to grow further from there. And then from a plan for the organization perspective, as you know, in fact, this is something that you can see over here. We have a new strategic narrative which is around scale at speed. That's the one thing I can share with you that we'll be sharing again later today, is the new strategic narrative for the company, scale at speed. And we believe that we are truly the only player in the IT services business that helps our clients meet their own objectives of getting scale at speed. So there is a plan for the organization in terms of learning, in terms of talent development, in terms of a cultural transformation of the organization. And we'll be sharing some of the highlights of this in the next 90 minutes.
The question on discretionary spend, the sectors where you're seeing some pickup or weakness, and if you'd like to give any sort of guidance for the year and on the headcount as well.
Sure. So look, as you know, we really don't give a guidance. But the one thing that I will tell you is we are now very confident that Q4 marks the low point in our year-on-year growth trajectory, right? Which means that we are confident that from Q1 onwards, you will start to see an improvement in our year-on-year performance. There will obviously be volatility between quarters because, again, this is a year of turnaround, so you should expect to see volatility. But beyond, Q4, there will be a year-on-year improvement, and we expect to come back fully to growth by the second half of the year. So that is a sort of a more explicit statement of confidence than we have provided in the past. In terms of discretionary spend, I feel that the volatility in spends is still very high, given our sectoral mix specifically and our exposure to telecom. Visibility is still limited. Some elements of our business, like our field services business that we have in parts of the Middle East and Africa, that is still stressed. So we will see volatility, but the confidence is there in the longer term trajectory of the company. Your question about there is no one-time client action that has resulted in revenues this quarter. Revenues this quarter were in line with what we expected. In Q3, for one of our businesses that we had shared in Q3 itself, we had an unexpected one-time item which gave us a lift this quarter, that quarter, which we did not expect to be repeated. So there isn't a one-time client-specific action. You may be confusing us with some other company.
Those were done more in the previous quarters, and I was summarizing for the year maybe. That's the confusion.
Yes, so the headcount as well, look, I think there is some reduction in the headcount that reflects the business volume that we are seeing. But I will say that we are the one company that is steadily adding fresh graduates, and we are continuing on our path of absorbing 1,500 plus fresh graduates every quarter, and we are also building out a intensive program to train these under the new Chief Learning Officer that we've hired. So we are adding headcount in terms of fresh talent.
Sorry, I'll just take another question virtually. This is from Anisha Jain from ET Now. Hygiene question on margins. Calculated number at 4.4% versus reported 7.4%. What's the gap? Also, what are the levers for margin growth? Also, FY25 will be a growth year, but given the low base, could growth be high single digit or low double digits in FY25?
I'm not sure what she's looking at, but 7.4 is the EBIT margins. There's no gap in that. We look at, ask her to send the deals, we look at respond. What was the second question, Abhilasha?
What are the levers for margin growth?
Yeah, we'll talk, as Mohit mentioned, we have another less than 90 minutes to talk about it, and we'll share everything in that unwrap.
Perfect. Please go ahead.
Hi Mohit, Ayushman here from Business Standard. So of the large deals that you have won, just wanted to get a sense of what proportion of those large deals are cost takeout deals, and which are really the digital transformation led and the AI led deals. If you can just talk about that. And secondly, will you be going to campuses this year?
So the answer to your second question is yes, we will be. We are looking to continue adding to the fresh graduate pool that we have. In terms of your question on large deals, right? Look, I think the answer isn't as clear-cut as you can imagine, because both of the large deals that I spoke about, right, the telecom large deal and the fintech large deal, both of these have a fairly significant AI and automation component, because clients are looking for us to use those to drive significant productivity, to drive significant benefits in employee and client experience. So both of these deals do have a significant automation and AI component to it. And in terms of sectors, as we said, one in telecoms and one in financial services.
Thank you.
Any other questions from the
Rohit from Business World. So in the press release you have kind of highlighted that you're looking forward to client spends in FY25, and the deal momentum is also something that you're highlighting. So I just wanted to understand what kind of perception you're having when you talk about growth, when you're talking about growth for Q1 and onwards.
So look, like I said, and like everybody else in the sector has said, right, that there is visibility is still limited, and there is still a lot of volatility because discretionary spend is still low. For us, particularly given our very high exposure to telecom, the volatility is a little bit compounded. But we have confidence that we will, see an improvement in our year-on-year trajectory starting in this quarter, and it will pick up as we come to the second half of the year. And we hope that visibility will improve with time.
The next question is from NDTV Profit. You mentioned last time that focus will be on top clients. However, the same has been a lower percentage of your revenue. What are your plans on such accounts?
Yeah. So, like we said, that this is a multi-year plan, right? We have been quite candid in the last call that we're in a early phases of a turnaround for TechM, right? And in the early phases of any turnaround, you do expect to see a lot of volatility. If I was able to promise that we would see an increase in our top client growth consistently from the first quarter, I would not call it a turnaround, I would call it magic.
Any other questions from, can we
yeah.
pass the mic?
Hi.
Okay, Chandra. go ahead.
Hi, Mohit, Chandra here. Mohit, even back in September, October, you unveiled a restructuring or a reorg plan, right? Where you said you will organize the company vertical-wise instead of geography-wise, which has come into effect from Jan 1st. So just want to understand, is the plan today different from that? Does it take it forward? If you can give us some clarity. And secondly, this green shoots that you're talking about in the second half, I mean, what is giving you the confidence? Because most analysts have sort of written off the current fiscal because there is pressure not only on discretionary spend but also on the other projects. So if you can give us some color. And based on what you said earlier, so you will hire 6,000 freshers this year, Tech Mahindra?
Yes, that's the plan.
Okay.
So, to your first question, what we had announced in October was the new organization structure, and you're right, the new organization structure went into effect from the 1st of January. And the new organization structure essentially was, first of all, we decoupled sales and delivery, right? So we moved into a service line model where we have service lines working under our Chief Operating Officer, Atul Saneja. As far as the market-facing SBU units are concerned, they are vertical within a geography, right? So within the Americas, we have verticals. Within Europe, we have a vertical structure, so it's vertical within a geography. And this structure has gone into effect from the 1st of January. What we're going to be talking today is about more details about the structure and how we expect it to speed up our growth, how we expect it to speed up our margin improvements. What we have stated about revenues is that, look, we feel that we are at a low point in our year-on-year trajectory in the current quarter, in Q4, and we expect to see an improvement from there. We're giving it based on the visibility that we have just now, and like I've said, I do expect that given the fact that this is the first year of our turnaround, that we will see a degree of volatility. But as of now, we do expect to come back to, to positive year-on-year growth in the second half of the year.
Varun, you had a question?
Hi, Mohit. Two questions, sir. Firstly, all throughout this year, you've been talking about exiting certain client engagements, and we've seen in the number of active clients also declining. Just in simple words, when the macroeconomic slowdown or there is a little bit of challenge getting business, why would a large company like TechM discontinue certain client engagements? Doesn't it make sense to continue with the client engagements, and perhaps when the overall growth story is much better, then perhaps you end the current client engagement? That's the first question. The second question, again, among all IT services companies, TechM is perhaps the only company which says 40% of our workforce are BPO employees. And your legacy has always been, it started with a kind of a captive for British Telecom. Does Gen AI and the rise of more Gen AI tools, does it make Tech Mahindra more vulnerable to these new technologies, and would this also change as part of your 3-year roadmap, what you've outlined? Thank you.
Sure. Thank you, Varun. So look, you've got two questions. Let me answer the first question. Right? The first question is, essentially, it's all about focus. We want to make sure that we are driving focused growth for the clients who we want to grow, and for the clients, the sort of clients that we want to do business with, right? So we have a very clear sense of the must-have accounts that we have, that we want to go after, and the sort of clients that we want to grow because there is significant headroom for growth for us. There are significant transformational solutions that we can take to them. So that is part of our strategy, right? Like any organization, we have a limited amount of resources, and we want to focus our resources to where there is the greatest degree of potential. It is not like we are, that we are sort of mindlessly exiting clients. It is about, focus and driving growth where we see the most long-term potential, right? To your second question, we do have a very large and a very successful BPO business, but it is under 20% of our overall revenues. Our BPO business also has completely transformed over time to where it does a significant amount of domain-specific vertical BPO and a fair amount of high-end horizontal KPO type activities. So our BPO business also is being transformed, and across a number of parameters and across a huge number of ratings, we have gotten rave reviews for the performance. So in a nutshell, the BPO business is is less than a fifth of our overall revenue, and the BPO business is really highly regarded and growing fast and a profitable portion of our revenue, and it's very important for us, right? As the tech and the operations elements start to come together, I feel that this unique combination will really provide a lot of value for our clients.
Hi Mohit, Beena here from the Economic Times. While you outlined that there is volatility and uncertainty that continues, you mentioned you are seeing some green shoots from Q1. Besides telecom, where is this growth likely to come from? And are you looking at more geographies given that there is some slowdown in the US markets?
Yeah. So if you look at our business, obviously, we have a leadership position in telecom and in manufacturing. In telecom, like the rest of our peer group, we have seen, challenges in the past 12 months, but our manufacturing business has done extremely well. It has done extremely well in terms of year-on-year growth. So we continue to see that as an important avenue for growth for us. We also have close to $1 billion financial services business. We have a large and growing healthcare, retail, travel, transportation, and hospitality business. So we expect, growth in all of these verticals, right? In terms of geographies, we have a focus on growth within the Americas, where we are underweight compared to our peers. We have a large business in Europe that we are keen to grow, and in other parts of the world, we will selectively grow in certain key priority markets.
In terms of deals, are you seeing some price competitiveness that's increasing given the whole slowdown overall in the sector? And one more thing on the leadership changes, you've seen a lot of changes. Overall you've hired your senior leadership is growing. Could you tell us, are you still going to see some beef up going on, and are we likely to see more hiring across the senior leadership?
Sure. So I think, from a leadership hiring perspective, I feel that we've got a very good mix in TechM, right? In the sense that we have retained a lot of the long-tenured, highly capable and highly performant leadership in TechM. So we've actually had very limited attrition at the senior management level. Some people have obviously moved on for their own aspirations, most of which have been entrepreneurial aspirations, right, rather than going to our competitors. I do believe that the leadership build-out is by and large complete at TechM. We do have some key roles for which we will be hiring, and some areas where changes will be made. But I would like to mention that over the past 9 months, there has been an incredible amount of stability in the leadership team, right, which is something that I'm very proud about what we've been able to accomplish.
Sorry, we have time for one last question. I know Hari.
On the deals piece, right? You're right. I mean, there's always been a lot of price pressure from a large deals perspective, and that is why, as Rohit pointed out, we have been quite selective about the large deals where we have participated. I'm also proud about the fact that when you see the large deals numbers that we give out, these have been very robustly audited, and so these are very credible numbers that we fully stand behind, and they should give you a sense of our future growth trajectory.
Hi, I'm Haripriya from Reuters. Hi. I looked at your Q4 numbers. For CME has declined about 16.5% YOY during the quarter, right? So I wanted to understand, are you consciously looking at sort of moving your dependence away from CME to maybe BFSI? That's one. Two is a follow-up to Varun's question. In terms of the number of active clients, it has sort of been on the decline. Is that only a factor of you choosing to get away from certain engagements, or is there something else at play over there as well? Yeah.
Sure. So look, I think there is absolutely no plan to marginalize telecom. Telecom is at the very heart of TechM, and there is no route to TechM's success and relevance that does not go through telecom, right? So telecom, along with manufacturing, will always be at the heart of the TechM story. The decline in active clients is very much part of a conscious strategy by us, which both Rohit and I had articulated at the very start of my tenure. And it really goes to focus, right? We want to focus on the most important geographies, the most important verticals, and the most important clients, because every organization only has so much of energy, and we want to focus it where it has the most potential. Because otherwise, over time, organizations get very complex and the focus goes away. And especially if you look at, at our focus as an organization, right? Scale at speed. We will really be missing out on the speed component if we're carrying clients that add very little to our story, and clients to whom we can also add a very limited amount of value.
Mohit, hi, Rukmini from Fortune India. Mohit, out of that 500 million TCV that you have announced, can you give us some color on, the tenures that you're looking at? What kind of tenures are these deals, large amount of them?
On an average, when we look at all our TCV wins that we announced, our tenure is around 3 to 4 years. So you will see some being shorter and some being towards the 5-year mark, but on an average between 3.5 years is what typically you see as an average.
Sure. Mohit, also, TechM historically has been buying in its revenues, right? After you've taken over as CEO and maybe after having taken stock, is there baggages that you need to shed going forward? Are there redundancies in any of these acquisitions that have been done earlier? And given that you're coming as an outsider, right, you might have a very different view of some of the acquisitions that have been done earlier.
Yeah. So we always take a very close look at our portfolio and see, what could potentially be done better elsewhere. I don't think that there is anything specific that we have to report at this time, but on the other side, we are very focused on organic growth, right? I think we've been quite clear about that we've been very focused on organic growth rather than transformational M&A at this time.
And also when a company is perhaps at its lowest, Mohit, how difficult is it for anybody to go and convince a client to sort of give you work and pose that faith? Is that a challenge that you guys are facing currently, and probably...
No, that's not of all the challenges we have, that's not a challenge at all, right? At the end of the day, TechM has a wonderful brand with clients, a wonderful brand with employees, and we have huge strengths also given our history and the Mahindra Group connection, right? So whatever challenges we may face, many of which are reflective of the industries in which we operate and are reflective of our peer group as well. The strengths of TechM, the strengths of our talent pool, the depth of our engineering expertise, these are all clearly recognized by clients and by analysts.
And how you would be engaging with the Mahindra Group? Is there some sort of a structure, or do you have a different view of that?
Yes, again, so I think we have a very clear sense of how this synergy with Mahindra will be built. There are three themes, and we'll be talking about that later today.
Thank you, everyone. We'll now be concluding the conference. I know you have a question. We'll take it up. I'll make sure that Mohit answers it for you, but we do have a hard stop. And the recording of the conference will also be available on our website. And thank you all for coming here, and thank you everybody who joined us online. Thank you.